16 months. China's central bank just extended its gold buying streak to 16 consecutive months, adding another 30,000 ounces in February, while gold trades above $5,000. At the same time, COMEX registered silver dropped below 90 million ounces, down 31% since October. Two markets, same macro environment, completely different behavior. One tells you what central banks do when they know something's coming. The other tells you what happens when the physical market starts breaking away from paper control. The PBOC's February purchase brought total holdings to 74.22 million fine troy ounces. The buying cycle started in November 2024, 16 months without a break. That's 42 tons accumulated since this current run began. What makes this significant isn't the size of each monthly purchase, it's the consistency. Central banks don't buy in a straight line for 16 months unless there's a structural reason. This isn't opportunistic. This is strategic reserve reallocation. Compare that to global central bank behavior. The World Gold Council reported net purchases of just 5 tons in January, well below the 12-month average of 27 tons. Global central bank buying slowed. China didn't. While other central banks paused or reduced purchases as gold climbed past $5,000, the PBOC kept accumulating. That divergence matters. When price sensitivity stops influencing a buyer this large, you're not looking at tactical positioning. You're looking at long-term reserve diversification driven by factors that have nothing to do with quarterly performance. Gold now represents 9.6% of China's total foreign exchange reserves. For context, U.S. gold holdings represent roughly 65% of reserves. Russia sits around 23%. China's allocation remains structurally low despite 16 months of continuous buying. The room to grow is enormous. The geopolitical timing aligns. Middle East tensions escalated throughout February. The Iran conflict entered its second week. Oil crossed $100 per barrel on certain benchmarks. The dollar index hit 5-week highs near 99. In that environment, central banks historically increased gold allocations. But most didn't. China did. Shanghai Gold Exchange withdrawals totaled 126 tons in January, essentially flat year over year but 11 tons higher month over month. Chinese gold ETFs added 38 tons in January, the strongest start to a year on record. Retail investment demand surged alongside official sector buying. The pattern emerging here isn't just central bank accumulation. It's synchronized demand across official and private sectors. When both move in the same direction, it changes the floor price. Markets can still correct. Volatility spiked above 90% after gold's recent whipsaw from record highs. But the correction finds support at higher levels because real money keeps bidding. Here's the critical detail most coverage misses. China's private gold demand shifted structurally in 2025. Bars and coins rose 35% to 504 tons. Jewelry demand fell sharply. For the first time, Chinese households treated gold primarily as a balance sheet asset rather than adornment. That shift reinforces the official bid. When private investors and central banks both accumulate for defensive reasons, the demand becomes less elastic. Price doesn't deter buying, it validates it. While China stacks gold, COMEX registered silver is vanishing. As of March 6th, registered inventory sits around 88 to 90 million ounces, depending on the data source. That's down 31% since October 2025. Total COMEX inventory, registered plus eligible, stands near 366 million ounces, down from 532 million earlier in the cycle. The decline isn't gradual, it's accelerating. February 2026 delivered 25.18 million ounces, the highest February delivery volume in modern COMEX history. March already has 10,526 contracts standing for delivery, representing 52.63 million ounces, against 86 million ounces registered when first notice day hit. Do the math. March delivery demand alone represents 61% of available registered inventory. Add the 25 million ounces delivered in February. That's 77 million ounces demanded across 2 months, against current registered stocks of roughly 88 million. COMEX just delivered 86.4% of its current registered inventory in 60 days. That's the highest 2-month delivery rate in exchange history. And it's happening while speculative positioning collapsed 77% year over year. Managed money long positions dropped from 54,415 contracts in February 2025 to just 12,121 contracts in February 2026. Translation: institutional and industrial buyers are taking physical delivery immediately, not rolling contracts or waiting. They're front-running the supply crunch. The COMEX Stress Index, a composite measure combining coverage ratio, inventory trend, paper leverage, and vault outflows, currently sits at 81 out of 100. The all-time high was 88. We're in the 95th percentile of physical supply stress on this exchange. Coverage ratio dropped below 15%, the threshold historically associated with delivery squeezes. There are now 6.9 times more paper claims than deliverable metal. Open interest significantly exceeds warehouse stocks because most futures contracts are designed to settle financially, not physically. But when financial settlement stops being voluntary, when counterparties demand physical, the ratio becomes the problem. January 2026 wasn't even a major delivery month. It typically sees minimal activity. This January processed 33 to 40 million ounces in the first 2 weeks alone, a 7 to 10x increase over historical January averages. By month's end, estimates reached 40 to 49 million ounces delivered. That's not profit-taking, that's panic hedging. Market participants accelerated delivery requests before March arrived because they expected both opportunity and risk. They secured metal before the pool shrank further. Simultaneous with January's surge, metal flowed from COMEX to London at extraordinary pace. Registered inventory declined 18 million ounces during the first week of January, while deliveries totaled 33.45 million, meaning the balance was sourced from already allocated inventory or eligible stock conversions. Why London? Lease rates. London lease rates spiked to 34.9% on October 9, 2025, with intraday peaks hitting 39.2%. By late October, they declined to 5.6%, but remained elevated relative to normal sub-1% levels. High lease rates signal tight physical markets. When the cost to borrow silver for short-term delivery spikes that high, it means available metal is scarce, and lenders are pricing in significant supply risk. The COMEX system is structured around 2 inventory classes: registered and eligible. Registered metal has a warehouse receipt and can be delivered against futures contracts. Eligible metal meets exchange standards, but isn't currently available for delivery. It might be allocated to clients, pledged as collateral, or held by custodians who aren't obligated to release it. When analysts say COMEX has 366 million ounces total inventory, they're including both categories. But only the 88 to 90 million registered ounces are actually deliverable. The rest requires the owner's consent to convert. Think of it like a bank customer with $100,000 in an account. Technically, it's there, but $50,000 is earmarked for a mortgage payment next week. $20,000 is pledged as collateral for a loan, and another $15,000 is in a CD that hasn't matured. The headline number is $100,000. The truly liquid amount is $15,000. That's COMEX inventory right now. Headline numbers look comfortable. Effective deliverable supply is razor thin. If March sees 15 to 25% of open interest stand for delivery, a conservative assumption during supply stress, demand could hit 75 to 132 million ounces, against 88 million registered. Now connect COMEX stress to what's happening in Shanghai, because that's where the real story emerges. Shanghai silver recently traded at $125 per ounce, while COMEX was at $112. That's a $13 premium, 11.6%. In late January, the premium hit $14 per ounce. In December 2025, it spiked to $8 per ounce, which was considered extreme at the time. The gap keeps widening. Shanghai Gold Exchange operates differently than COMEX. It's primarily a physical delivery market. The AG T+D contract facilitates direct trading and delivery. When Shanghai prices decouple from Western futures, it signals real physical demand outpacing available supply in Asia. China accounts for the largest share of global silver consumption. Solar panels, electronics, EVs, China dominates industrial silver use. When Chinese buyers pay $13 to $14 more per ounce than Western markets, they're not speculating. They're securing supply they cannot source elsewhere at any reasonable time frame. Shanghai inventory tells the story. Combined SHFE and SGE silver stocks dropped 56,000 kilograms in 1 week at the start of March, a 7.4% decline. SHFE alone fell 50,600 kilograms, down 16.5%. SGE dropped 5,400 kilograms. Inventory depletion while premiums spike. That's not financial positioning, that's physical tightness. Chinese export data supports this. Silver shipments from China in 2025 reached a 16-year high. China's exporting record amounts of silver while maintaining massive premiums in domestic markets. That only makes sense if domestic industrial demand is so strong that even record exports can't relieve pressure. The backwardation in Shanghai futures adds another layer. Spot silver has been trading above futures, meaning immediate delivery costs more than future delivery. That's the opposite of normal market structure, where future delivery typically carries a premium to cover storage and financing costs. When backwardation appears, it signals acute near-term supply shortage. Buyers will pay more for metal today than metal in 3 months, because they're not confident the metal will be available in 3 months at any price. Shanghai lease rates responded accordingly. Rates that normally sit below 1% annually have been running at 5 to 6% since late 2025, after spiking above 34% in October. High lease rates mean lenders demand significant compensation for the risk of lending metal they might not get back. Compare that to Western markets. The SPDR Silver Trust, SLV, trades at a 5.7% discount to net asset value. Western retail isn't buying. In 2011, during the last major silver rally, SLV carried an average premium of 17.3% across the full year. Right now, it's 23 percentage points below that level, sitting at a discount instead of a premium. Western speculative sentiment hasn't returned. This move is being driven by Eastern physical demand and institutional accumulation. It hasn't been contaminated by retail froth that collapses quickly. If Western retail eventually comes back when price action becomes impossible to ignore, the SLV premium shift alone, from 6% discount to potentially 10–15% premium, compounds returns significantly beyond the physical price move. That spread represents a multiplier for anyone positioned ahead of the sentiment shift. The COMEX drawdown and Shanghai premium aren't happening in isolation. They're happening against a backdrop of cascading supply destruction that most analysts haven't incorporated into their models. Mexico produces 28% of global silver, nearly half of all primary silver production, more than any other country by a factor of 2. And Mexican production is collapsing. The Jalisco cartel New Generation lost its leader in February 2026. The resulting power vacuum detonated across 22 Mexican states simultaneously. Armed blockades across highway corridors, military-grade weapons at roadblocks near active mining operations, direct targeting of mining personnel. 7 employees at Vizsla Silver's Panuco project were murdered in January. 7 men clocked into work and never came home. That's not collateral damage. That's targeted violence that stopped other workers from showing up. Fresnillo, the world's single largest primary silver producer, slashed 2026 production guidance from over 50 million ounces to 42 to 46.5 million. That's a minimum 4 million ounce cut. But that guidance was issued before the latest escalation, before the Vizsla murders, before armed blockades spread to 22 states. Mining executives are privately suggesting Fresnillo's actual 2026 output could fall below 40 million ounces. That would be a 10 million ounce decline from previous expectations. From one company. First Majestic, Pan American, Vizsla, all facing double-digit stock declines, cost expansion from security expenditures, and potential project suspensions. Armed guards, armored vehicles, helicopter transport, Security costs have added $15 to $20 per ounce to all-in sustaining costs. At $85 silver, they're profitable. At $68 silver, CPM Group's bearish target, they operate at a loss after security costs. The bearish price targets being published physically cannot exist if Mexican mining costs are $15 to $20 higher than models assume. Here's the detail that turns this into a price catalyst. Transportation insurance. When silver concentrate must be trucked through cartel-controlled territory, insurance companies price the risk. As of March 2026, several major underwriters have stopped offering coverage for silver shipments in Sinaloa and parts of Durango entirely. Not increased premiums, stopped offering coverage. When you cannot insure a shipment, you cannot ship it. Banks won't finance uninsured cargo. Refineries won't accept uninsured deliveries. The entire logistics chain seizes. Silver that Mexico produces is becoming stranded at the mine site, physically mined but commercially unavailable. Mining companies report production based on what comes out of the ground. The market models supply based on those reported numbers. But the market actually receives only the silver that survives the journey from mine to refinery to exchange. Nobody is modeling this gap. JP Morgan's $81 average target doesn't account for it. CPM Group's $68 bear case doesn't account for it. Bank of America's $309 bull case mentions Mexican risk, but doesn't quantify the stranded production component. The actual supply reaching the market is lower than every major bank assumes, which means the actual deficit is larger than every projection. And the deficit is cumulative. The Silver Institute estimates 820 million ounces of deficit consumed beyond production since 2021. Add another 67 million ounces projected for 2026 at baseline. If Mexican production drops 15 to 18% due to security collapse, add another 30 to 36 million ounces to the deficit. Total deficit, 917 to 926 million ounces by end of 2026. Against COMEX registered inventory of 88 million. The annual deficit alone would exceed the entire deliverable inventory of the Western world's primary silver exchange. Two patterns converging. China's central bank buying gold for 16 straight months, while private Chinese demand shifts from jewelry to investment. COMEX registered silver dropping 31% in 5 months, while delivery demand hits records and speculative positioning collapses. The connection isn't obvious until you recognize what both signals mean. Physical markets decoupling from paper pricing. China's not buying gold because it's cheap. They're buying because they're structurally reallocating reserves away from dollar exposure. The consistency matters more than the size. 16 months without a break means the decision was made at a strategic level, not a trading desk. COMEX silver isn't draining because of speculation. Managed money is 77% lower year over year. This is institutional and industrial buyers securing supply before the pool runs dry. The delivery data proves it. 86% of registered inventory delivered in 60 days, while open interest collapsed. Shanghai premiums confirm it. When Chinese buyers pay $13 to $14 more per ounce than Western markets, while inventory drops 7% in a week, that's not arbitrage. That's real demand that cannot be satisfied through paper contracts. 3 things to watch this week. First, COMEX daily warehouse reports. Registered inventory updates every trading day. If the drain continues at current pace, 22 million ounces over the past 30 days, we're looking at 80 to 90 trading days until registered stocks approach zero at current withdrawal rates. Second, Shanghai premium each morning. If the gap widens beyond $15 while Western prices stay range-bound, it signals the physical market is breaking away from paper entirely. That's the warning shot before explosive moves. Third, March delivery settlement. We're at 52.6 million ounces demanded against 86 million registered. Final settlement data drops toward month-end. If delivery exceeds 60 million ounces, COMEX will have delivered 2/3 of registered inventory in a single month. China's gold buying tells you what central banks do when they see the macro storm coming. COMEX silver drain tells you what happens when the physical market runs out of metal to deliver against paper claims. Shanghai premiums tell you where the real price discovery is happening. Paper can suppress the tape short term. Algorithmic flushes, margin changes, ceasefire rumors, all can push prices down fast regardless of physical tightness. But the gap between physical reality and paper pricing doesn't close in a straight line. It closes in an event. This is educational analysis, not financial advice. Every number cited is available through public sources. CME Group publishes COMEX inventory daily. Shanghai Gold Exchange reports are public. PBOC reserve data comes directly from the central bank. Verify everything yourself using the links in the description below.